Alright everybody, so let's talk about interest rates. It was in the news recently, the Federal Reserve raised the interest rates above 5% to 5.25%, and this has impacted the market significantly. Now it's important to look at this in historical context, so if we zoom in here on this Federal Reserve data on the interest rates, we see that here now in 2023, the interest rate has been marching up steadily since late 2022 to now above 5%, and tracking back across time, the last time this interest rate was anywhere near 5%, was before the 2008 crash in the late 2000s, and then before that it was about that rate, 5% in the 90s. And the last time we've seen a rate greater than 5% interest rates was in the 1980s and the 1970s, where you can see here it reached routinely the 10% mark and the 20% mark. And so for people who think that we won't experience something like the 1980s or the 1970s again in interest, it might make sense, for example, to pick up some kind of interest-bearing object, whether it's a CD or something else, because again, the history bears out in the last 2 decades here since the 2000s, interest rates rarely stay above 5%. So let's talk about CDs now for a second. So this is what I just looked at in TD Ameritrade. It hasn't totally updated, but you can get below 1 year or up to 1 year CDs for a 5.08% interest rate, and then 1 to 3 years for a 5.1% interest rate, and you can lock in even up to 7 years of 5% interest rate. And so with the US inflation rate, it obviously is close to 5%, 6%. So right now, if you buy one of these CDs, net of inflation, you're not making any money. But here's the thing with inflation. As interest rates goes up and more people deposit their money into these locked objects like CDs, that will lower the inflation rate. So it's entirely possible that the inflation rate might lower in the coming months or in the coming years, making these CDs very viable. Now, there is a strategy and timing you have to do this, because if you think the CD rate is going to stay the same and maintain stability, it doesn't matter what kind of CD you get. But if you think, for example, the interest rate is going to go down soon, you might want to lock in one of these longer-term CDs so you can keep continuing getting that higher interest rate while the interest rate drops for everybody else. You can go up to 7 years or 5 years with this. If you think the interest rate is going to go up more from here, and we're going to get the 1980s and 1970s 10, 15, 20% interest, it might make sense to get one of these shorter-term CDs. And also, we have to factor in, too, what way do we think inflation is going to go? Is inflation going to increase? Then it wouldn't make sense to get one of these CDs. If inflation is going to drop, it makes sense to flood into these CDs as fast as possible and get the easy money while you can. So there's a lot of timing and strategy to this. I do say with these rates, I think the type of person who likes dividend investing is going to like CDs a lot more. And you're going to see a lot of, for example, content changing on YouTube, or even just investor preferences generally. The type of people who bought dividend stocks in the past for the 3 to 5% yield, they're going to look at things like CDs and just buy those. Because at the end of the day, a lot of dividend stock investors don't want to be in the stock market. They just want a stable return. They like, for example, an easy percentage rate they always get. They like passive, dependable income. They like fixed income. They don't like being a stock speculator. So this is definitely going to hurt the popularity of dividend stocks here in the future. So the inflation rate has been steadily dropping since July of 2022. It peaked at 9.1%. Now it's down to 5%. It stands to reason if the inflation rate keeps dropping, some of these CDs, if you lock them in for a long time, might make you money net of inflation. And by the way, CDs are extremely safe, FDIC guaranteed instruments. They're kind of like your savings account, but they have a little bit of a different structure. Again, they're FDIC insured. You get your stable return, now above 5%, probably approaching 5.2% once these CDs update. It might be something worth considering if you want a dividend-like income, but with more protections and safeguards against them versus, for example, just a stock. All right, that's all for this video. Watch this video on screen now that actually goes more into depth exactly what CDs are and how much money you can make for them and how they compare against dividend stocks. I'll see you in the next video.